A new leader is taking the helm at the Federal Reserve. This is important. The Fed chair is the most powerful economic actor in the world. His decisions influence the value of your money, your investments, your future. Kevin Warsh, President Trump's nominee, is a seasoned Fed veteran. He vows independence, yet inherits a monumental challenge. The United States sits on roughly $39 trillion of debt, with interest costs surpassing $1 trillion a year. Understanding what that means and how policy may respond is your best defense. Gross national debt reached about $39 trillion by early 2026, up roughly $11 trillion in 5 years. Debt is growing faster than the economy meant to support it. Net interest outlays topped $1 trillion in FY 2025, now the second largest federal expense after Social Security. As low-rate debt matures, Treasury refinances at higher average rates, pushing costs up. Higher debt drives higher interest costs, widens deficits, and forces more borrowing. A classic debt spiral. This isn't partisan, it's arithmetic. Raise rates and costs explode. Keep rates low and inflation erodes purchasing power. The size of the debt changes the policy calculus. Can inflation shrink the real burden of debt? Yes, but only under specific conditions. Inflation reduces money's purchasing power over time. If prices double, repaying $100 buys what $50 used to. Half the real value is inflated away. Crucial, this only works if interest rates stay below inflation. Negative real rates. Real rate equals nominal rate minus inflation. At 3% interest and 6% inflation, the real rate is 3%. Debt shrinks, just 3% per year in real terms. Borrowers benefit, lenders lose purchasing power. From 1946-1974, the U.S. combined growth, moderate inflation, and financial repression to cut debt GDP from 106% to 23%. The Fed steers interest rates and liquidity, powerful levers with trade-offs. Lowering policy rates and deploying quantitative easing, QE, can cheapen borrowing and lift inflation. QE raises bond prices and pushes yields down, reducing Treasury funding costs. Kevin Warsh has been viewed as a hawk, yet he affirmed independence and acknowledged elected leaders' views. Context matters. When fiscal needs dominate, central banks tolerate negative real rates to erode debt if they can anchor expectations. The dance. Keep real rates negative to chip away at debt without letting inflation expectations unmoor and credibility break. Letting inflation run can seem elegant, but it's playing with fire. Once expectations rise, inflation gains momentum and becomes hard to control. To stop it, the Fed may hike sharply, risking recession and even higher interest costs on new debt. Savers and fixed-income households see purchasing power erode, a hidden tax. Signal deliberate devaluation and trust in the dollar weakens. Investors demand higher yields or diversify away. Short-term debt must roll. If inflation fears rise, new borrowing costs jump, offsetting any gain from inflating old debt. The cure can be worse than the disease. This strategy is risky by design. Where to put your money? Stocks and real estate. Stocks are claims on real businesses that can raise prices and grow nominal earnings. Favor durable profitability and rising dividends. Cash flows that can adjust with inflation. Real estate is tangible and finite. Property values and rents often rise with living costs. With long-term fixed debt, you repay in cheaper dollars over time. Debt shrinks in real terms. Risks, illiquidity, management, local cycles. But the core principle stands. In currency devaluation, own real things, businesses and property. Beyond equities and property, hard assets, gold and silver, hedge currency, and policy risk. Gold can't be printed. Scarcity underpins its role as portfolio insurance during inflation and uncertainty. Recent surges show investors buying protection as confidence fades. Silver shares monetary traits with added industrial demand. More volatile, but potent in stagflation. Select tangibles can diversify. but require expertise and accept lower liquidity. In a world awash in new currency units, scarce real assets can preserve purchasing power. Tokenization turns properties into digital shares, offering fractional access to inflation-hedging real estate. It can boost diversification and accessibility. Still early, so diligence is essential. With a weaker USD bias, consider international assets to diversify currency exposure. Mind currency risk. Returns translate back to your home currency. Balance is key. You're not anti-America, you're managing concentration risk. Tokenized property markets could scale to trillions by the 2030s. Innovative, but verify the legal plumbing. Understanding is step 1. Action is step 2. In high inflation, cash reliably loses purchasing power. Keep a sensible emergency fund. Put excess cash to work in assets. Build an inflation-resilient mix. High-quality equities with pricing power and rising dividends. Real estate directly or via REITs and funds. A prudent hard asset sleeve, gold and silver, often 5 to 10% as portfolio insurance. Reassess debt. Long-term low-fixed loans can be valuable in inflation. Add international exposure to hedge a weakening dollar. Explore tokenized assets carefully. Start small, learn. Keep learning. Conditions evolve, principles endure. The math is forcing policy toward financial repression and inflation. Don't wait. Position in real assets thoughtfully, prudently, now.